What if the future of money isn't really about convenience, speed, or innovation at all? What if the next big transformation in finance market as progress quietly reshapes power itself? Central bank digital currencies, or CBDCs, are often described as nothing more than digital cash. A harmless upgrade. A natural evolution. But here's the unsettling question no one asks out loud. If CBDCs are so simple and beneficial, why are they being designed behind closed doors, rushed by central banks, and debated in whispers rather than public forums? This story doesn't begin with code or smartphones. It begins with control. I study, and like most systems of control, it didn't appear overnight. It was built step by step, crisis by crisis, always justified as temporary, necessary, and for your own good. Long before CBDCs, money itself changed form. For most of human history, money was physical, limited, and difficult to manipulate. Gold, silver, and later paper notes backed by something tangible. The system wasn't perfect, but power was constrained by scarcity. Governments couldn't create wealth at will. Banks couldn't expand endlessly. Inequality existed, but it had natural limits. That balance broke in the 20th century. Central banking rose as a solution to chaos: bank runs, depressions, wars. Institutions like the Federal Reserve, the Bank of England, and later the IMF promised stability through management.
How money became abstract.
Backing was loosened. Eventually, it disappeared entirely. What replaced it was trust in institutions. This shift had a consequence few noticed at the time. When money became numbers on a ledger, those who controlled the ledger gained unprecedented power. I think inflation became policy, debt became normal, asset prices rose faster than wages. Inequality began to widen, not suddenly, but structurally. Fast forward to the digital age, payments moved online. Banks digitized balances, yet one thing remained. Cash still existed as an escape valve. It was anonymous. It worked offline. It couldn't be programmed or restricted. It limited how much oversight the system could impose. That limitation became a problem. After the 2008 financial crisis, central banks discovered something uncomfortable. Lowering interest rates wasn't enough. Printing money helped markets, but it didn't reach everyone equally. Asset owners benefited first, workers last, sometimes never. The system needed finer control, more direct influence over behavior. This is where CBDCs quietly enter the story. Officially, CBDCs are introduced as a solution to inefficiency. Faster payments, financial inclusion, protection against private cryptocurrencies. But these explanations don't fully hold up. Existing digital payment systems already work. Inclusion could be solved with simpler tools. Cryptocurrencies remain tiny compared to state currencies. So why the urgency? Because CBDCs solve a problem central banks rarely admit they have: lack of direct control over individuals. With a CBDC, money is no longer just held in banks. It exists as a direct liability of the central bank. Every unit can be tracked. Every transaction recorded. And crucially, every balance can be programmed. At first, this power seems neutral, but systems don't stay neutral. They follow incentives. The rise of CBDC research accelerated after global shocks. The pandemic, supply chain collapses, inflation spikes. Each crisis expanded state intervention. Emergency payments were issued. Lockdowns restricted movement. Digital passes tracked compliance. The public accepted these measures because fear makes trade-offs invisible. CBDCs promise to make these interventions permanent, efficient. Imagine stimulus that expires if not spent. Benefits usable only on approved goods. Accounts frozen instantly for policy violations. Negative interest rates applied directly to savings. None of this is theoretical. Technology already allows it. Here's the cause and effect chain that matters. When money becomes programmable, power concentrates in whoever writes the rules. At first, the rules target obvious goals: crime, fraud, terrorism. Few object. Then come economic behaviors: discouraging saving, encouraging consumption. Still defensible. Then social objectives: carbon limits, health compliance, misinformation. Suddenly, money isn't neutral anymore. It enforces values. This is the breaking point most discussions avoid. Because inequality doesn't just mean unequal income. It means unequal leverage. The wealthy adapt. They hire lawyers. They move assets. They access alternative stores of value, real estate, equities, offshore structures. The middle and lower classes don't have those options. Their wealth exists mostly as income and cash flow, and CBDCs sit exactly there. When rules change, the burden falls downward. We've seen this pattern before. Quantitative easing inflated asset prices. Those who owned assets grew richer. Those who relied on wages fell behind. CBDCs risk repeating this on a deeper level, not just influencing markets, but shaping daily life. The fallout won't arrive as a single event. It will arrive quietly, through nudges, through incentives, through small restrictions that feel reasonable in isolation. Access becomes conditional. Spending becomes guided. Saving becomes punished. Opting out becomes impossible. Some will argue safeguards can fix this. Privacy layers, legal limits, oversight committees. History suggests otherwise. Emergency powers tend to persist. Surveillance expands faster than it contracts. Systems built for control rarely give it up voluntarily. And here's the most uncomfortable parallel. Every major financial system that promised stability through centralization eventually increased inequality. Not because of bad intentions, but because centralized power always finds ways to protect itself first. CBDCs are not evil by default, but they are powerful. Power without friction reshapes societies. Today, we are told this is about modernization. Tomorrow, it may be about compliance. The same infrastructure serves both. So what does this mean for you? First, understand that money is not just a medium of exchange, it's a governance tool. Whoever controls its design influences behavior at scale. Second, recognize that inequality isn't always visible as poverty. Sometimes it appears as reduced choices, fewer exits, and shrinking autonomy. Third, ask the question that matters most. Not whether CBDCs are convenient, but whether they preserve the ability to say no. Because systems that cannot be refused eventually stop needing consent. The future of money is being written now, not later. And once the engine is built, it won't announce when it turns on. If this video challenged how you see digital money, share it with someone who still thinks this is just about faster payments. Subscribe if you want deeper breakdowns of the systems shaping your future. And ask yourself one final question: when money itself can be programmed, who really holds the power?